Well, welcome everybody to today's webinar. I'm Jessica Grosskopf, a Nebraska Extension educator, Panhandle Regional Economist, and the director of the Nebraska Women in Agriculture program. Today is a part of a weekly series of webinars produced by Nebraska Extension's Farm and Ranch Management team in the Department of Agricultural Economics. Find a complete schedule and past recordings at farm.unl.edu. The Rural Response Hotline remains a great resource for ag professionals across the state, providing mental health counseling, information regarding legal assistance, financial clinics, mediation, and more. The hotline's toll-free number is 1-800-464-0258. We also have a wealth of resources related to stress and wellness at ruralwellness.unl.edu. Today is also the fourth in a series of webinars co-sponsored by the Nebraska Women in Agriculture program aimed at assisting farmers and ranchers to better understand their financial positions. These panel discussions are held on the second Thursday of every month through May and offer education on things like financial statements, financial record keeping, ratios, cost of production, and more. Today's webinar focuses on the proposed changes to capital gains that many farmers, ranchers, and agribusiness professionals are wondering about and how they might affect succession and transition planning for the operation. Today, joining me for our discussion on these proposals and their potential impacts are Katie Samples Dean, an attorney specializing in agricultural law. Her practice, Samples Dean Law, is out of Bridgeport, Nebraska. We also have joining us today Paul Neiffer, a certified public accountant specializing in income taxation, accounting services, and succession planning for farmers and agribusiness processors. He is a principal at CliftonLarsenAllen, based out of Washington State. Thank you for joining us, Katie and Paul.
You're welcome.
We're going to hop right into the questions. And again, this is a panel discussion. So what's going to happen is we have a couple of questions that we're going to start our discussion off with, but then we are going to turn to the chat box. So if you have questions for Katie and Paul, please make sure that you enter them in either the chat feature to the panelists or in the question and answer feature, which are both located at the bottom of your screen. So we're going to start off with Paul. Paul, can you tell us right now, how are capital gains currently handled?
Yeah, and farmers have an interesting perspective on capital gains, especially when we're dealing with livestock operators, ranchers, and so on, because they have some special capital gains treatments that other other manufacturers would not have. So let's start at sort of a 30,000-foot view and then drop down a little bit. Right now, if you are in what we call the 15% tax bracket, and for married couples, that's roughly if your taxable income is under $80,000 of taxable income, then that difference between 80,000 and your taxable income without the capital gains, that's actually taxed at a rate of 0. So a lot of your capital gains, if you're a lower income farmer, you potentially are not going to owe any federal tax. Now, state of Nebraska will be an additional tax. Now, once you start going above that 15% bracket, your tax rate is going to be 15%, all the way up to the start of what we call the 37, well, it's the old 39.6 bracket, which for married couples is going to be roughly in that $600,000 range. So the way to look at it for most of your capital gains, and that includes qualified dividends from mutual funds and from common stock, is you're going to be 0 up to about $80,000 of income, assuming combined income. And then from about 80,000 up to about 600,000, you're going to be taxed at 15%. And then above that, you're going to be taxed at 20%. Now, there are a situation where you have let's say investment capital gains. You're selling stock. You bought Tesla a year ago for $200 or $100 a share. Now it's $600 a share, and you sell Tesla. If you're above 200 or 250,000 of gross income, not taxable income, but gross income, you're going to have that extra 3.8% net investment income tax. So that's essentially how capital gains work. The tax rate on capital gains is always, under current law, is always going to be lower than the tax rate in your bracket or wherever your income is at. So it's definitely a preferential tax treatment.
And Paul, just to clarify, when you were saying tax of like the 80,000, you're talking adjusted gross income, right?
No, actually on that part, that's actually on taxable income. So you subtract off your standard deduction or your itemized deductions. I'll just give a quick example. Let's say you had $50,000 after the standard deduction, $50,000 of farm income, and then you had $50,000 of long-term capital gains. The first 50,000 of ordinary income would be taxed at 10 or 12%. The excess up to about 80,000 would be taxed at 0. And then the amount above that would be taxed, likely in this situation, could be at 12% or it could be at 15%. And the one thing I forgot to mention, ranchers or hog producers that have breeding stock, they've raised that breeding stock. So they've, they might have a sow, they might have a boar that they've raised, they might have a bull, they might have a cow that they've raised. If that cow or bull is held for at least 2 years, or if that sow or boar is held for at least 1 year, that is what we call a qualified 1231 gain. And that's also subject to the long-term capital gains tax rates, and it's not subject to self-employment tax. So that's another nice feature of what we call 1231 gains, which then become capital gains. So I think I've pretty well, Jessica, I think we've covered mostly how it works. I am seeing some things coming in via the chat. I don't know if we want to cover those now or if we want to keep going. I can go either way. I have no problem with that.
Yeah, so let's address the comment in the chat from one of our participants, and it says the state of Nebraska has a provision that the state tax cannot exceed the federal tax. Check the box, and the state will be equal to the federal. So if there's 0 federal dollars, Nebraska is also 0.
Nice feature. Now, other states such as Iowa and perhaps Nebraska has the same. It's hard to know all 50 states. I mean, I'm pretty good on the federal laws, but like in Iowa, if you end up selling farmland or farm assets you've held for at least 10 years and you materially participate in it, that is tax-free in the state of Iowa. Now, Nebraska may have the same type of option. Now, I do see another question. So corporations, let's talk about corporations. If you're an S corporation, that capital gain from selling raised livestock and so on is going to flow through to your individual return, and that'll end up being tax-free. However, if you're a C corporation, right now, it doesn't matter if it's capital gains, doesn't matter if it's ordinary income, it's all taxed at a flat 21% tax rate. So C corporations, we're not really talking capital gains for C corporations because they're exactly the same.
Just to touch on, we do not have that law in Nebraska that Iowa has. Sorry, guys.
Okay.
All right, so let's move on to our next question, which is what are the proposed changes to the capital gains? So Paul, you want to take us
what's
off?
being proposed? Sorry, I think you were asking what's being proposed. I just had a little bit of a feedback issue there. So we have several proposals that have been floating around. President Biden, when he was running for president, had mentioned that he would like to apply the top tax rate once, and we're not sure if it's total capital gains or your income including capital gains. I think it's the latter, goes over $1 million. So at that point, you would be taxed on the excess. We believe it's on the excess. Capital gains would be taxed at 39.6%, if in fact that becomes the new top rate. Now, will that affect many farmers? Perhaps not. I think in the normal course of business, it probably wouldn't affect very many farmers. It could affect some, but let's say you're getting close to retirement and you plan on selling, let's say you're going to sell some of the land or you're going to sell some assets that create capital gains, and it's a large capital gain, because that's typically when farmers face the largest amount of income taxes when they retire, then that 39.6% bracket could kick in. Now, what's probably even more important to understand is that we had the STEP Act that came out last week, and something equity proposal. They're trying to basically do wealth transfer is what they're talking about. in that situation, if you decide to gift or you're going to transfer assets upon your death to your kids, to your non-spouse, at that point, you're going to trigger a transfer tax. Now, that could be a capital gains tax on those items that, like farmland, that would be subject to capital gains, or it'd be ordinary income. So you're transferring grain, you're transferring equipment over to your kids, you're gifting it. That gift, once you go over $100,000 cumulative, is going to be taxed as if you sold it. So that's something that Nebraska farmers and ranchers really need to understand, that if this proposal goes through, it's going to rapidly change a lot of our succession planning that we've done for the last 10 or 15 or 20 years for our ranch and farm clients out there.
I'm just going to
So,
add, or I'll
and I
let
do,
Paul
go
go
ahead, Katie.
on. The other question I've been getting a lot in reference to capital gains is the proposal to get rid of the step up in basis, because you
Okay.
aren't taxed on the full, but just, I'll let Paul explain that. He does much better, but I know that's a question I've been getting a lot.
Yeah, and the proposal, it's for the 99.5% act that Senator Sanders, Bernie Sanders, out of is he Vermont or New Hampshire? He's somewhere up in that area, proposed. And the step back, they talk about eliminating bases, but they really are not eliminating step up in bases if we impose a capital gains tax. Under a capital gains tax, what happens is the person transferring either at death or during lifetime incurs the tax, but due to the fact that they incurred a tax, that actually provides a step up for the heirs. So that seems to be both the step back and the other act that Senator Sanders up, but at a cost of having an immediate taxation when you do the transfer, and that would be a big deal.
So I think it's really important to note that a lot of these are proposals. And I think that's something that we really need to pay attention to. Is at this point, this is all speculation in terms of what will actually be passed for the future. So let's take some of these examples, and Paul, what do you think the biggest change would mean for farm and ranch estate plans based on these proposals?
Well, based on these proposals, I shouldn't say most, a lot more farm and ranch ranch clients of ours are going to be facing either estate or gift tax. I'm actually more worried about the gift tax, I think, than I am the estate tax, because under the proposals that they're talking about, both Biden and the STEP Act wants to decouple wants to decouple estate and gift tax. And what they mean by that is they'll allow you to have up to $3.5 million when you pass away that's not subject to estate tax, but during your lifetime, you can only transfer $1 million. And then even if you transfer it during lifetime or transfer it at death, you're going to have that immediate capital gains tax. So it sort of flips all of our planning. It flips it 180 degrees. Before, we wanted assets to go through the estate because we got the step up. There was no capital gains tax, no transfer tax. At death, we wanted it to go through sort of an estate so we could get that step up. We could get the heirs wouldn't owe any tax, or they could start depreciating the assets all over again. Under all of these proposals, likely we don't want it to go through an estate. We probably want to try to do gifting quicker. We want to take advantage of some type of maybe take advantage of the annual exclusion. Now, Bernie Sanders' proposal says you can only gift those type of assets $20,000 total, well, $30,000 total per year per person via you. Under current law, let's say I have 10 grandkids and 20 kids. Let's say I got 30 people that I want to give $15,000 away to. I can give away that $450,000, don't have to file a gift tax return, doesn't eat into my lifetime exclusion. Under Bernie's proposal, if you give away cash, you can still do that. But if you want to put something into trust for your kids or grandkids, or if you want to transfer closely held interests in your farm or your land, your limit's going to be essentially, I'll turn it over to Katie to jump in, add any color on that.
I agree with a lot of that. And the problem when you come to farm and ranch planning is we don't want to give it to 30 people. Usually we have 1 to 2 that we want to give it to. And so I don't want to say this, but if any of this comes to fruition, unfortunately, it is going to change what we do. It just is. Some of that will be paying more tax. Some of it is putting it more into entities and being able to discount when we gift, which we haven't talked about, but that's what I've seen we are starting to do out here. A lot of is putting it into some sort of entity so we can discount. And so that way you can transfer more. For those that you don't know, if it's a closely held corporation or LLC, you can discount the value anywhere from, I don't know, 25 to 50%. Paul would know a better, that's the range I've seen. And so we can gift more. Honestly, at this point, it's kind of, as Jessica said, it's all proposal.
Yeah. Now, I'm glad you brought that up, Katie, because Bernie's proposal also says that you no longer can discount anything.
That's what I'm actually worried about
when you transfer. Yeah. And I think what that means is, like I say, I think we'll start even if there's a tax being incurred, I think we may start transferring more during lifetime, in that 15, 30,000, and we may do a sale. If you have a low tax rate and capital gains rates are going to be 0, and in Nebraska it can be 0, it looks like, because of their law, then transferring $20,000, $30,000, $40,000 per year to your kids via a sale or a gift might make a lot of sense, because you are trying to tamp down that estate value. But one thing, even if this gets passed, what we found out in estate taxes, nothing's permanent. We may get a new administration in 3 years. Likely the House next year is going to flip over. Senate may or may not flip over. But we have to understand, taxes are sticky. Once there's a proposal placed into effect that raises taxes, it sometimes is very difficult to get that change. I mean, just go back to, when President Trump came into office, we had a Republican-controlled Senate, Republican-controlled House, and a Republican in the presidency. They said, we're going to eliminate ACA, we're going to eliminate Obamacare. Never happened. So, that's my concern, is that we think, that this might only be a 1 or 2 year or 3 year or 4 year, but we could have something like this for 10 or 20 years. Remember, we've spent an extra 5 trillion, whatever the number is. We're going to have to pay for it somehow.
And just to do a little non-tax education for anybody, and if Paul disagrees, he can step in. We have a Democrat House and Senate, but with the filibuster rule that they just passed again in the Senate, they have to have 10 Senate Republicans agree in order to pass this law to be able to get it to Biden. So just keep that in mind. You do have to have 10 Republican senators in order for this to pass. So I keep telling all my clients, take a deep breath. And I've seen a couple of questions about, does the proposal eliminate discounts?
Yeah.
And there's a variety. Keep in mind there are,
unless they use reconciliation.
Yes, which they just did, and they can only use it once a year. So they can use budget reconciliation to pass on a straight majority once per calendar year, which they just did. So they could, if in 2022, use it again. So just so you guys know, and I've seen a couple of things come through, just so you also know, if you haven't gathered this, there are multiple proposals coming through. There isn't one just full one, as far as there's Bernie's, there's Biden's, and they all have different suggestions.
Yeah. Although we've heard, the Senate, whoever the Senate referee, I'm going to call it the Senate referee, just came out and said that they would allow the Senate to amend the reconciliation process that they just did this year. So, and again, I think this is based on a fiscal year, not a calendar year. So they could pass another one for the fiscal year beginning October 1 of 2021. That would contain estate and capital gains tax adjustments, I would think.
I don't know if budget
they're-
reconciliation, and this might be wrong, can be used for taxes, but I'll look that up. So just so you all know.
Well, it essentially is used where it affects the budget. And so taxes
Right.
affect the budget. So
There you go.
yeah. So I do see some questions here. So let me just address some of them. The proposed estate exemption, it is 3.5 million. Now, they will increase section 2032 cap A for farmers only. And under that proposal, it would allow you to reduce your estate by a farm estate by up to $3 million. So effectively for farmers that really are in farm, all of their assets are related to farming, or most of their assets are related to farming, you would be able to have an estate of about 6.5 million for dad, 6.5 million for mom. So about 13 million and still not owe any estate tax. Now, if the STEP Act goes through, that's true for estate tax, but over on the income tax side, due to the fact that only $1 million is going to be exempted, that means, let's say you're worth $13 million as a married couple, you've transferred all your assets over to your kids, let's say at death, and let's say you get killed in a car wreck at the same time. So it's all going to the kids. Yes, you may not owe estate tax on $13 million of assets, but collectively you're going to owe a capital gains and ordinary income transfer tax on 11 million. So don't think just because you might only be worth 8 or 10 million as a couple that you're not going to owe any type of tax when you pass away. That's the problem with the combination of the STEP Act and the estate law changes. If those go through, we now have to worry about both. We can't just worry about one versus the other. We do have to worry about both. And then if let's say your estate is over 3.5 million, then your tax rate is 45%, not the current 40%. Then once you go over 10 million, it's at 50%. Once you go over 50 million, it's 55%. And then if you're lucky enough to be worth $1 billion, then it's 65%. And the interesting thing is Bernie's proposal, I'm going to call it Bernie's proposal, lists all the billionaires in the United States. And it goes through and says, under my proposal, here's how much extra estate tax these billionaires are going to owe. Well, Bernie's wrong. All these billionaires, because Bernie's proposal doesn't address this, all these billionaires, Bill Gates, Warren Buffett, whoever it might be, Warren Buffett's in your state, they have set up charitable trusts that when they pass away, all of their assets are going into the charitable trust and it's completely estate tax free. Whereas the farmer in Nebraska or rancher that wants to transfer $20 million of value to their kids, they face an combined estate and income tax, a cost of maybe $5 million. So the reality is the farmer rancher in Nebraska is going to pay more tax than Warren Buffett will when he passes away. So, until they address the ability for billionaires to set up charitable trusts, private foundations, charitable trusts, and so on, these proposals don't have any legs for the billionaires. They have legs for the ranchers and farmers in Nebraska, but they don't really have that much legs, in my opinion, for the billionaires. So
let's go back to the chat box here.
Okay.
And let's start with this one. Do you guys have any diagrams or slides of the current capital gains law and each of the proposals that are coming out, or do you know where participants can see exactly what those proposals are side by side? And if the answer is no, that's okay.
I don't.
I would say, I was going to say that for those that are interested, they could certainly go to our blog. It's farmcpatoday.com. So farmcpatoday.com. Very easy to sign up for it. I wouldn't say that there's necessarily a chart on there. I probably will put it on once we see maybe a couple more proposals. But it does go through all the details as far as the STEP Act, the 99.5% Act, and so on. Matter of fact, I just did another post this morning on how, people have said that Bernie's proposal drops the annual gift exclusion down to 10,000, and you can only do $20,000 in gifts. Well, the answer is no. You can do 15,000 still. It's just when you start doing transfers of appreciated assets into a trust or farm assets in as far as closely held businesses over 2 years, then the limit is 30,000. So you do have to read through the proposals. Sometimes when they tout certain things, you actually have to read what their law actually is saying, and you find out, well, their headline was X, the reality is Y. So that's so I would certainly suggest going over to the blog.
So the next question from the chat is that you have referenced children and grandchildren. Can you explain what happens if there are no children, but rather somebody wants to pass on assets to a niece or a nephew? So Katie, do you want to take that one first? Maybe talk under some of the current laws, and then maybe have Paul go on maybe some of the proposals?
Sure, and I'll talk a little bit more specifically about Nebraska and let Paul go federal. So it doesn't, in Nebraska, the issue that we haven't talked about is we have a state inheritance tax, and there is absolutely no way around it. Trusts don't get you around it. Corporations don't get you around it. LLCs, it is what it is. It funds our county budgets. And so what it is if you pass to spouse, it's free. If you pass to tier 1, it is taxed at 1% over $40,000. If you pass to tier 2, it is 12 or 13% over 10,000. Sorry, I'm getting my numbers mixed up because there's a proposal in our state legislature to change this and up the limits. And then the third is if you're not related at all. And that's taxed at 18% over $10,000, just so you all know. So in passing to nieces and nephews, you fall into tier 2. And so just know it can be we have seen a lot of farm ground go to nieces and nephews without any cash to support it. We have to sell to be able to pay the inheritance tax. When it comes to an inheritance tax is based on who it goes to. Estate tax is just based on the estate itself. The person who died, the inheritance is who gets it. And so that's a little bit different. And so as far as I'm aware, second tier is $15,000 exempt and taxed at 14%. Thank you, Alan. And so as far as I am aware, federal, there is nothing like that. And so it's grandchildren provide a little bit extra sometimes, but I'll let Paul cover the rest.
Yeah, no, that's, whether at the federal level, whether it's a sibling, a niece, a nephew, a child, a grandchild, you have to worry about generation skipping tax. It really doesn't matter. The only one that matters, are you giving assets to your spouse? If you're giving assets to the spouse, then that's an unlimited exemption, and they haven't eliminated that in any of these proposals. If you're giving assets to any non-spouse, unless it's a charity, then you're going to essentially pay a state tax on that at the federal level, if in fact you're over the exemption levels. And then also, if we do have this transfer tax, at death, that tax that's calculated, it reduces the estate tax, so it's a deduction against the estate tax. And then if it's related to what we call non-liquid assets, it isn't cash, it isn't Google stock or whatever it might be, but it's your farmland, it's your ranch land, it's your farm assets, the ranch assets. The IRS is going to allow you to pay that tax over a 15-year period, and it's at a very low interest rate. Now, the problem with that, it sounds great. Hey, we get to pay it over a 15-year period, but there's a formal lien that gets filed on that property. And if you ever want to refinance that property, likely your lender is going to require you to pay off that lien. So that's something to be aware of, is that you do have to deal with the actual formal lien against that property. So again, if it goes to a spouse, tax-free. If it goes to anybody else and you're over that exemption limit, then yes, you will owe a tax on that.
And to just elaborate a little, because I didn't do the best job at the beginning. Yeah, so second tier is $15,000 exemption per person, taxed at 14%. It's due 1 year after the date of death. So there are a lot of times in Nebraska, we are scrambling to get evaluation done to even tentatively pay the inheritance tax. And if you do not pay it timely, it is taxed at a large percentage interest. So that's your niece and nephew issue here in the state.
So just to follow up on that, and I think you kind of addressed it in the last answer, do transfer tax and estate tax, and I'm going to add in inheritance tax, do they run concurrently or do they have different triggers? And so if you want to just clarify that answer for the question in the question box for me.
Okay, so if these proposals go through, and that's the answer, I mean, this only applies if the proposal goes through. The transfer tax is triggered once your appreciated assets at death exceeds $1 million. So let's pretend like that we have a farmer, and let's say they're single, and they have $6.5 million of farmland, and the farmer paid $1 million for it 50 years ago. So we got a $5.5 million gain. Now, under all these proposals, you know, if Bernie's goes through and the step back goes through, estate tax, he likely would not owe any estate tax. He's got the $3.5 million exemption. He's got the extra $3 million of 2032 cap A that he can use. However, the transfer tax, he's got $5 million of appreciation. He's allowed to have $1 million of appreciation on those type of assets. So we're going to take $5 million, likely $4 million of it's going to be taxed at 39.6% if the proposals go through, plus the state of Nebraska tax. So you're looking at 50% on $5 million. Again, they're sort of tied together, but they don't use the same exemptions. They don't have the same rates. One is a transfer tax based on income tax rates. Another one is an estate tax based on estate tax rates and estate tax rules. So if all of these proposals go through and you're worth $5 to $10 million at death and you have a lot of appreciation, you're either going to owe estate tax, or you're going to owe a transfer tax, or you're going to owe both under all of these proposals.
So I have two questions.
I did see one comment on there. It says, you know, it did say, well, I was going to chime in. It says many billionaires are not intending to set up charitable trusts for dealing with this. If this really goes through, I'm going to guarantee almost every billionaire is going to set these up, and most billionaires have them already. So if you think they don't, they do. So just sort of an ad lib on that one.
So I have two questions that are fairly similar, and one says, what is the probability? And the other one says, what is the likelihood of these capital gains tax changes being passed this year and being made effective for the 2021 taxes? So gut check, how fast and what is the likelihood of these actually happening? So I'm going to go with Katie first if you want to respond, and then we'll go to Paul.
Sure. As far as I know, even if they pass this year, they don't apply this year. They would apply for the next year. Tax laws we're not that quick. And likelihood, I'm just going to give my honest opinion. I don't think it's very likely that all of this will pass. They're not going to get all of this into one. They are likely going to get pieces of it or somewhere in the middle. I will tell you, they do what attorneys do. They start with throwing this much in so that they can get meat in the middle so that it looks better than the extreme that they proposed. And so likelihood that something gets passed, I think, is fairly high. Likelihood that all of this gets passed, very low. And if it gets passed in 2021, it will not apply until at least 2022, if not 2023, just like the last law that was passed when Trump was president. It didn't apply until the next year. So I had a client die and they did not get the $11.8 million exemption because they died between the passage of the law and when it became effective.
All right, so now we have some more specific questions. Again, if you have questions for our guests, please go ahead and put them in the chat box and the Q&A. I'm doing my best to keep up with them. There are lots. But one of the questions that came out of the chat box was, what are the potential impacts of these proposals if you want to gift land to a nonprofit after death? So we're going to start with Katie on that one. Gifting land to a nonprofit.
If you give to a nonprofit, it's the same as a charitable trust. And as far as I've seen, Paul can correct me, there are no changes to donating to a charity. We get to donate to a charity, inheritance tax-free and estate tax-free. And so if you go to a nonprofit, which is a 501c3, a charity, and a nonprofit does not mean that the organization does not make money. It means that there's no shareholders profiting off of that. It has to go back into the organization. But as far as I've seen, there is nothing that touches charitable trusts or nonprofits in this. It would go tax-free. But a farm cannot qualify as a nonprofit.
And I would certainly agree with that. Like I said, both Bernie's proposal and the STEP Act didn't have any changes on any transfer to a charity. It still remains exempt from estate taxes, exempt from this transfer tax. So I think that's still, the way it's going to be.
So Paul, our next question from the chat, I'm going to give to you. And it came a while ago, so you'll have to infer.
Okay.
Isn't the proposal worse than losing the step up in basis? If it triggers tax at the time of the transfer, then it would discourage doing any planning until you are forced to do so at death. So do you want to comment on that?
Remember, if we're talking small amounts of gift during lifetime, those are going to be taxed at a very low rate. You just have to decide or plan. It may be worth making, $50,000 or $100,000 a gift during your lifetime. Now, another question I saw that came up, and it's very important to understand, we are never a proponent of giving more assets to your kids than what you need to live on. You're not gifting your land if that's your retirement plan. You're not gifting away assets if you need them to live on. We never are a proponent of that. I'm strongly, if your kids end up having to pay a little bit of extra tax because you wanted to keep that land in your name for retirement income purposes, that's fine. We can deal with that. But I still think instead of delaying, this may be a case where we want to accelerate gifts. Now, one thing I do need to add based on what Katie had mentioned about being retroactive, the STEP Act does indicate this transfer tax will be retroactive. It's retroactive to January 1. And I have a feeling that the Democrats really want it to be retroactive to January 1 because they know if they make it prospective, they'll make the estate tax effective as of January 1 of 2022 or January 1 of 2023. But I really think they want to make the transfer tax effective January 1 of 2021 because they know if we do the estate tax and we're going to drop it down, everybody's going to rush out and make gifts now. Well, they're going to say, you can go ahead and make the gifts, but we're going to have a transfer tax. We're going to tax you either a capital gains tax or some type of a gift tax. Well, the gift tax wouldn't apply. That'll be in 2022. So that's why I'm not really telling people rush out and make gifts right now. That is the wrong advice to give right now until we get a better idea as to how this plays out. I'm sort of like Katie. I don't think all of this is going to go through, but this is not a normal year. This is a pandemic driven, progressive driven. We're going to tax the wealthy. And the wealthy right now is anybody over $1 million. You have more than $1 million of assets. The progressives in Congress views that as being wealthy. And we know, like in my area or in Nebraska, a quarter section of good ground in Nebraska is going to be well over $1 million. You're looking at, closer to $2 million. So, and I don't think most farmers would think if I own a quarter section of land outright that I'm wealthy. Well, according to the progressives in Congress, yes, you are wealthy. Sorry, I got off on my soapbox there a little bit. But.
I'm going to jump back just quick to the question of like gifting if they're retirement. So one strategy we've used is start getting rid of some of your assets and then you're paid as an employee of the farm. And that's how you keep your income while transferring the assets throughout life. And then you do keep shares, you just become a minority shareholder, and then you take it as a salary. So that is one tiny option of doing that.
So let me go back to those two questions. So
I definitely agree with that.
So there are two questions I think you guys are addressing. The one is, how do you address a parent's need for income from a property in contrast to the need for lifetime gifts to avoid estate tax? If I give it all away, where does my revenue come from? And so, Katie, do you want to address that from your perspective as an attorney in regards to retaining some sort of income from the property at this point, given the current tax structure?
Sure. So what I mentioned was you can start to gift whether it's shares in a corporation or shares in an LLC or land or transfer or however we're doing that. Sometimes we're transferring it as compensation for working. Granted, remember that's still taxed as ordinary income if whatever rate you're taxed at. But a lot of times that's lower than what the estate tax would be. And then what we're doing is you can retain some interest, and so you're getting your LLC, your interest off the ownership, but then you can be paid a salary or whatever off of that. And so sometimes that's what we're doing is, matriarch, patriarch are no longer working, but we're going to pay them. One is paid on a 1099 as a consultant for the farm. One is paid just as whatever. I mean, the government doesn't require, you can pay them as an employee. So then what you need to be careful with is talk to your CPA with their social security, things like that. But that's one thing that we have used is to pay them a salary while starting to transfer ownership so that way they can maintain their income while getting rid of the assets.
So I'm seeing a lot of very specific questions related to specific scenarios within the chat. And one thing I really want to encourage you is to get your estate planning team together. And yes, you need multiple people. You need an attorney and you need a CPA who understand your operation and understand agriculture as a whole. And they need to be in the room together to discuss these potential changes and your potential plan. The best thing you can do is come to them with specific transfer objectives to say, what do you want to happen to your assets? I want my daughter to be the farmer or be the rancher, or whatever that is. And don't be married to a specific tool, a trust, LLC, an entity, or whatever it may be. Be married to what you want to do with your farm or your ranch, and let the professionals work with you on your very specific items in terms of the current culture with the tax law and the state that you're in. So that'd be my one big piece of advice is if you're sitting on this call and Paul and Katie are great, but they're not your CPA and your lawyer likely. So you need to get those two individuals at minimum, add a certified financial planner to that room as well, an insurance agent, to get this discussion pulled together and really have a plan in place. If you have not reviewed your estate plan in the last 5 years, now definitely is the time to do so, and know that estate planning is not a one-off event. It is a journey that as these laws and as the environment you work within changes, we might have to modify and amend your estate plan to fit the current environment. And I know that can be frustrating because you feel like you've got it done, but we need to be constantly tweaking this as we move, throughout our life cycles. So that's my soapbox for the moment. So I really encourage you to get that team together. Paul?
Yeah, Jessica, I was going to jump in. We didn't really address the effect of these proposals on trusts. A lot of farmers, and Katie, I'm sure you take advantage of trusts, but both the STEP Act, what the STEP Act says that if you put your assets, your farm assets into a trust, you're going to owe the transfer tax every 21 years. Now you said, well, I set up my trust back in 1970. They can't go after that. What they've said, any trust that was in effect before 2005, you're going to owe the transfer tax beginning in 2026. So every 21 years, whatever the appreciated value of your trust is, you're going to have to pay a transfer tax on it. The other thing is if you have at least gross income of at least $20,000 or assets of at least $1 million, you now have to file a balance sheet. You have to file an income statement when you file that trust return, and they're going to require you likely to value all those assets at fair market value every single year, which is going to be very costly when you're dealing with farmland or other assets. Now, over on the estate tax side, what Bernie's proposal, and I think Biden's proposal is similar, that's the senator that's head of the Senate Finance Committee. What they're saying, you can set up all these dynasty trusts you want. And what a dynasty trust does is allows you to go ahead and get those assets out of your estate for multiple generations. And they're saying, yeah, you can do that, but we're going to tax you every 50 years. I think that proposal is going to go through. They do not like the idea that anybody can escape estate tax, for 100, 200, 300 years. And then there was a question dealing with SLATs, spousal limited access trusts, IDGITs, intentionally defective grantor trusts. All those trusts, if those proposal goes through, are going to be worthless. They're going to be, you're not going to get the income tax effect you want. You're not going to get the estate tax effect you want. Grantor retained annuity trust, grants are going to be not worthless, but for most farmers, they're going to be worthless. So the ideas of using all these trusts to escape either income tax or estate tax, if these proposals go through, that's gone. Now,
And
life
I'll
insurance
add-
trusts will still be around. Go ahead, Katie.
I'll add dynasty trusts we don't really have here in Nebraska. I know South Dakota has them. And so especially out here in Western Nebraska, we have a lot of people that are familiar, but we were just discussing on an attorney thread. We haven't tried it, but the likelihood is low. We don't have the law to support it. And so just so you know, that's not really an issue. And no, this isn't my niece. Sorry, it's the baby. She is cranky. So she joined us.
Yeah. Well,
right.
and again, even in Nebraska, you don't have dynasty trusts, but you could have a trust that easily could go on for 60 or 70 or 80 years. And under the STEP proposal, you're going to be paying a transfer tax 3 or 4 times before that trust ends. So
Right. We just don't go 100 years, but
right.
yes.
Yeah.
So there's a couple of questions that we're going to pull from the chat. And I think this is a great question. I love the person who sent this. How do you evaluate an attorney who specializes in agricultural estates? So what questions, I'm gonna add to their question, and we'll ask it for CPAs as well. What questions should I be asking to a professional like you to know if you are the right attorney or CPA for me as it relates to agriculture? So I'm going to start with Paul on this one. Paul, how do we evaluate someone who specializes in agricultural estates?
I think there's 3 or 4 things that you need to key in when you're discussing, discussing with a CPA as far as farm estate planning and so on. Find out for them, excuse me, how many farmers do you work with? How many farm estate plans have you ever been involved with? Do you, what type of professional CPE do you attend related to farming? Those would be some of the questions I would be asking. Also, I would ask for 3 or 4 references from them as to, okay, you worked with multiple farm families and you say you're successful. Give me 2 or 3 of those so I can at least interview them and find out, are you really successful or not? At least those would be some of the key questions I would be leading with.
Katie?
So kind of the same, although you cannot ask an attorney for references because we cannot tell you who our current clients are. Only our clients can. Word of mouth is somewhat helpful. What I would ask, and what I've seen a lot of is, do they know and understand agriculture? Somewhat. Most attorneys in Nebraska do, but kind of, there are a lot of attorneys that have a set way they handle farm and ranch families in transitions, and that is great if that's what you want. But I would ask, do you kind of tailor this to the different farm and ranch families? What options do you propose for clients? Some are very successful in going straight to trust, some aren't. I would ask, just kind of talk. I mean, I've been interviewed a couple times. What are my theories? What are my thoughts? Ask them what they've used as examples, things like that. Ask your CPA for a good attorney. When they're young, like I am, we don't necessarily have as many referrals, but I work with a lot of CPAs, ask other people, and just kind of, ask them what their strategies are, what their plans are. What I will tell you is asking them currently what they plan to do to fight the tax changes may not be a good question, because some of us are like, we don't want to go to transferring right away. We don't want to jump to any conclusions at this point. And so and if you like them, I guess, or like working with them, is also somewhat helpful.
And I should mention, our standards are similar. What Katie had mentioned, we can't voluntarily give you a reference. We can talk to our clients and ask if they want to be a reference and get that in writing. We just can't mention their names, just to mention names.
So here's another question related specifically to the proposals. If a farmer or rancher has put money into a 401k, do these dollars count towards the dollar level for calculating taxes under these proposals? Do we know an answer to that question?
Paul, you can answer.
Okay. I wasn't sure. I didn't hear the last part. I've had a little bit of bad connection here. Yes, 401k is an asset just like anything else, including life insurance. A lot of my clients, I'll talk to them, what's your net worth? They say, well, I'm only worth, let's say $5 million as an example. And then I ask, how much life insurance you have? Well, if I pass away, that's another 5 million. Well, your estate value is not 5 million, it's 10 million. So all of your assets, annuities, 401k, IRAs, those are all part of your estate. Now, a lot of these proposals go through. I think you're going to start seeing more and more farmers. I had a discussion with a farmer yesterday on this. They may name a charity or a donor advised fund as the person that's going to end up getting their IRA or their 401k, just because, if it has to go through both an estate tax and a transfer tax, because it's income in respect of decedent, by the time you add up all those taxes under these new proposals, it could very easily be 80 or 90% of the value. And if you do want some money to go to charity, that's probably likely the best resource to go to charity.
Or I'll piggyback on that. Spend your 401k to pay for your needs and cost of living and quit living off the farm's income. And that would save some of our problems. I have a couple farm clients who have a great 401k and we keep living off the farm income. And it would, because they like to see, the 401k, and they don't, and so if we could spend that down, then it's not taxed. And then we get to keep some of the necessaries in the farm. That's what I am also encouraging people to do.
Yeah. Well, and speaking of IRAs, last year, because of the pandemic, people didn't have to take out their RMD. I don't know how many clients I've seen this year, not necessarily all of mine, but returns I've reviewed. If they'd taken out $20,000, it would have been completely tax-free. So because they didn't take out an RMD, they now are going to have an extra $20,000 at some point is going to be taxed. Whereas if they'd taken it out, then and it would reduce their RMD. So it's still important, even if you don't have a lot of assets. And I think with most farmers in Nebraska, they're going to have assets. It's important to have those discussions with your tax advisor, your attorney, especially on the tax side, at least annually before the end of the year, because that way we can help you make the right decisions.
So there are lots of questions. Again, more on the estate and succession planning side, not necessarily related to the proposals. I just put a resource in the chat, farm.unl.edu/succession. That's where our resources related to farm estate and transition planning are at. And you have probably been on our webinars with our estate educator, Alan Van Alec. So I would really encourage you, if you're wanting to learn more about very specific items, to look there on how to start the succession process. So there are a couple of questions. How do we speak out against these proposals? Again, if you do or don't agree with these proposals, always work through your grassroots or your membership organizations like the Farm Bureau, the Cattlemen, Farmers Union, those kinds of organizations to express your concerns or your support of any legislative action, whether that's state or federal. And then the other question would be, And kind of wrapping up in some final thoughts is, what can I do right now? So I'm going to start with Katie on this one. Katie, what is your recommendations for what action can be taken right now?
So I may get on my soapbox a little here. I think from the estate planning, capital gains planning perspective, the best thing to do right now would be to get in and talk to your attorney. And the first conversation that I personally have, and I probably drive some CPAs nuts, is it's a question of what do you want to see happen and what's realistic. And in some of my plans, it is a complete tax plan where that's what we're trying to do, is protect against paying taxes. In others, we want this operation to continue on, and you have to pick one or the other as the priority. The other can be very close second, but especially out in Western Nebraska where margins are very thin, we usually have to pick one or the other. So that's the question. Do you want this to continue to be an operating farm? How many of your kids or grandkids or whoever is going with it? If we have kids and grandkids, that's another question here, is are you transferring it to a non-relative? Because that's a whole different other issue. And so if you come in and we can kind of see where you are and where your ultimate goals are, because in my opinion, no matter what the estate tax is, no matter what capital gains tax is, what your goals are with your operation come number one. And so if you don't care, if you don't want it to continue on, then that's a different conversation than if you have 2 kids that are on farm and 2 kids that are off, or just 1 kid that are on. So for me, the best thing you can do is come in. We can have a conversation about where you are, what you currently have, what you want to see with the operation. And then I am starting to do some reorganization of things just based on pure operational necessity. And then I'm kind of sitting, I know other attorneys are drafting trusts or are setting things up. I'm a little concerned with the transfer on the trust, like kind of the CPAs that I work closely with have kind of just decided to sit tight on a lot of these, waiting to see, is all of it coming, is some of it coming? Because yeah, if the transfer is retroactive, then no point in transferring a bunch of stuff right now. If trusts are then taxed every however many years, that becomes an issue. If they're not, so kind of just sitting on it. But so a lot of these organizations, we need an LLC formed, or we got to start the ball rolling. And so having a conversation. The other thing I will tell you is, you guys call your CPAs in about September, October, make appointments. I had quite a few farmers who did not realize CFAP payments last year were taxed as ordinary income. They have $250,000 of ordinary income that their accountant did not know about until January. So call your CPA, and don't call them in December. We like to take Christmas, and so do they. Call them in October, call them, like, get in there, and then kind of just get all your ducks in a row. Figure out, what do you have for IRAs? What do you have for accounts? We can do a lot of the front end of estate planning without doing the estate plan now. That's my big soapbox on it, I guess. And more importantly, what do you want done? And what do you need to have done? So that's kind of the bigger questions.
Paul, same question. So what can we do right now?
I'm going to echo Katie almost 100%. I'm going to say it's wait and see. There's no reason to panic. There's no reason to go out and to some degree, the worst thing you might do now is put assets into a trust, because if some of these proposal goes through, you may end up having a transfer tax owed now, and then your heirs are going to have a transfer tax owed in 21 years. Or whereas, if you don't put it into trust, we can wait. Again, a lot of these proposals may happen now, and 5 years from now, they're going to get watered down or unwound. I mean, I've already seen Wyden back off on some of the proposals for the corporate tax side. So these are proposals. Now, they've been bandying about for the last 5 or 10 years. So I think some of it's going to happen, but don't panic. Let's just wait and see. Keep in touch with your CPA, or, keep in touch with our blog. I mean, I post on that 3 to 5 times a week. So we'll keep you updated.
So I saw a quick question of, who do you go to first if you haven't started planning? What I would tell you is, if you have an attorney or a CPA or someone you trust, start there. They may have referrals. And if you like that person, use them. If you don't, try to find someone else. But so most of you have a CPA because you turn in taxes. If you like your CPA, go to them. If not, ask your buddy at the coffee shop who they use or things like that, and then just pick one. And then the attorney is usually a good starting point, um, because we kind of spearhead the whole thing. But other than that, just pick whoever you use the most and are close with.
Great. Well, thank you for joining us today. I'm sorry we weren't able to get to all of your questions, but I really do appreciate your participation within the chat. Be sure to check out farm.unl.edu for a recording not only of this webinar, but all of our past webinars and a schedule of our upcoming events. Next Thursday at noon, join us for an overview of carbon markets and carbon banks and how these may impact Nebraska producers. Just as a reminder, you will also be receiving a short survey in your email about today's webinar, and we would really appreciate your feedback and input on future sessions. So we are going to, we saw Paul's information. Oh, and Katie just put hers in. So if you have any additional questions directly related to Katie or Paul, again, we encourage you to reach back out to their websites. You can also check out farm.unl.edu/succession to see the University of Nebraska's resources related to farm, estate, and transition planning. Thank you all for joining us today, and we will see you next week.